Good afternoon, everyone. My name is Samira Mohammed. I'll be moderating this session. I'm delighted to be joined by an exceptional group of panelists who will be bringing a rich experience from their respective markets and institutions. Together, we will be unpacking real stories from the Kenyan market, the Nigerian, and as well as the Ethiopian market. And hopefully learn from the experiences of these rich markets. This is a timely conversation for Ethiopia as we are in the process of developing our capital market as well as starting to regulate it. As you all know, we launched our first securities exchange back in January, and now, currently, publicly held companies are in the process of being registered with the authority, and hopefully some issuers are looking to raise capital for the first time from the public. So this panel, titled Public Markets Unveiled, Real Stories from Kenya, Ethiopia, and Nigeria, is designed to move us past theory and into practical experiences. To bring life to this conversation, I am joined by panelists that have sat in rooms where real deals happen. Some have also helped companies go through this process. Some of the panelists have regulated it. We have Leonard Matu from AIS Capital, who has worked with issuers in Kenya as well as the Rwandan market. We also have Mr. Peter Ashade, who is a group CEO of United Capital. He leads one of the most influential capital market institutions in Nigeria. We also have Simon Olsen, who brings a comparative lens to this panel discussion with his rich experience working with mature markets as well as emerging ones. Last but definitely not least, we have two regulators from the ACC Nigeria, Ms. Adama Babadoko, as well as Solomon Bekele from the Ethiopian Capital Market Authority. I know my introduction does not do any justice to the background you and the works you have done, but I'm pretty sure as we go through the discussion that the audience will get an even clearer view of the expertise you bring to this panel. To start this conversation, I would like to bring my first question to Leonard's attention. Before companies go to public or when they start raising capital from the public through capital market, one of the most foundational things is the readiness of the issuer. So from your experience working in East African markets, what are the main signs that indicate a company's readiness to go public? I also want you to tell us one or three things that companies should pay attention to when they decide to go public as well as raise capital from the capital markets.
Thank you for inviting me to the panel. So, let me start by what I would say are key indicators, and I'm sure every one of the panelists here has their own views. But just to start with what has been mentioned in other panels and in the morning, strong governance is key. And what we mean by that is you look at clear organization structure, there is a board, there is a separation of ownership and management. Yeah, it could be a family business or it could be a business where their shareholders are actually running the organization, but there is clear policy framework to separate the two. And there is also history of periodic reporting, whether that's internal or to an external party, and that's backed by independent audits. So that governance tends to promote transparency, and we've had that term being used before. The other key indicator is on the profitability. And here we look at predictable earnings and cash flows. Investors are interested in cash flows. And that should be backed by established products and markets that are well understood. Investors like to diligence this. They like to conduct sensitivity analysis, so they want to see how this business would perform under various conditions. And in public equity markets, the equity investors look for growth. And in the debt markets or in the bond market, the investors are looking to minimize risk. They want cash to be able to return to make their investment returns. The other key indicator is brand. Companies with a strong brand and public goodwill tend to perform very well. And this we see in mostly retail backed markets, and which is what we are hearing in Ethiopia is. And if you want to grow, if you want to attract retail investors, then it goes, the investors need to understand your product, they need to know you. That familiarity helps. And we've seen this in markets like Tanzania. The banks there have been able to maximize on their retail networks to be able to attract retail investments in the various corporate bonds that have been issued. Another key indicator is robust or sector regulatory clarity. So investors like a business that is regulated. And if banks, insurance companies, telcos, they are all best suited to come to public markets. It doesn't mean if you're not regulated or you don't fall under these sectors that you can't come to market, but it just gives that extra comfort. Let me just add that, that if these indicators are not there, it doesn't mean that you cannot access public markets. There's a lot of work being done in Ethiopia and across the continent in terms of capital markets issuance readiness. And we've had this morning that with the new licensees of investment bank and advisors, there are places you could go as companies. And the market is looking for these advisors to actually provide this support. So for the question of what 2 or 3 areas that companies should pay attention to, one is governance and willingness to embrace this transparency. So work on your policies, work on your governance, and get comfortable with making market disclosures. And then the other one is financial quality and predictability. I mentioned that. And then defending your market position and creating that story, compelling story to investors that fits with the timing. And right now there's momentum to come to market. So a story around that would be quite compelling to the investor base. Thank you.
From your discussion, what I've captured is that readiness is not only internal preparation, but it also relates to making disclosures. It could be in the form of reporting. So one of the things that when a company decides to go public, what comes as a consequence for that is the accountability it owes to the general public. So that, I think, is where the regulators come in. And I want to get Mr. Solomon's opinion on this because as a regulator, when a company decides to go public or decides to raise capital from the public, what are the main regulatory standards that the Ethiopian Capital Market Authority sets? And as we're in the process of registering these publicly held companies, what challenges have you faced so far?
Thank you, Samira, and good afternoon, everybody. So let me start from the last part of our question. The historical process and the challenge. Basically, that means I'm going to give you a snapshot of what happened behind the scene. Basically, what you see in the front is, this happened, and this is where we are. But what was the process like behind the scene? So when we started, we started sharing the regulatory frameworks with the ecosystem in June 2022. So at the time, what we learned from that process was there was a high amount of skepticism. Everybody was saying it will never happen. Ethiopia is not going to go this route. So since then, we've been, one thing that we learned is from that process was we have to do a lot of education. So we have to do a lot of engagement. We've been doing that engagement for the last 3 years. So last year, around this time, November, in the summit, one of the landmark regulatory framework was issued. That was the public offer and trading of securities. And that directive put the legal framework for everybody that has to follow, everybody that's going to issue securities has to follow. So what happened once we did that was, a lot of challenge. We faced a lot of challenge after that. The first challenge was regarding service providers. So initially, at the time of the passing of this directive, there was only one service provider or transaction advisor that was licensed by ECMA. So we had to find other service providers that would be providing this kind of service. So that was the big issue, and we started receiving, application for them. And then the next issue was qualification, the capital adequacy, as well as staffing. That was, especially the staffing part was not an easy issue to solve, because, previous to this, we did not have any practice here in this regard. So there was nobody that's have, the necessary qualification to do this kind of advisory services. So what we did was, allow those individuals to associate with other practitioners outside of the country, and it has its own problem. The first one is, if we allow them to bring in advisors from outside, they have to have the financial wherewithal to retain this kind of services. Since most of them did not have that kind of financial capacity, we had to allow them to have some kind of contractual relationship where they don't need to have this kind of out of pocket capacity. Then on the issuers side, the issuers came in with a lot of requests. The first one being, we can do it by ourselves, so why are you forcing us to retain the services of a transaction advisor? Then there comes the exemption, the request for exemption. And there comes the exemption for extension. And there comes a request, it's going to cost us a lot of money, so why are you subjecting us to this kind of requirements? So ECMA has to handle all these requests in light of not all the requests from the individuals, but we have to see it from the ecosystem. So we have to be fair. We have to be fair. We have to be predictable. We have to be communicative. So we communicated every decision that we have. We're not going to make any exemptions. We're not going to allow you to have extension. We're not going to allow you provide you any extension. We have already given you 1 year since the introduction of the directive to comply. That's enough. We're not going to allow you to have any more extension. What this gave us is, the service providers. We communicated this to the service providers, and the service providers were encouraged, because it's costing them a lot of money to be in this business. So they knew from the get-go that we're going to be supportive of them, we're going to be protective of the ecosystem. So what it gave us was, the first reaction that we had was, it's not going to happen. Then there come a point where they say, maybe it's going to happen. Now when we're firm, they say, it's happening. Then the next challenge happened. That next challenge was receiving an avalanche of registration applications. Before the deadline, we had only 10, probably a month before the deadline, we received around 10 applications. After, 2 days before the deadline, we received 50 applications. So currently we're swarmed. We have an avalanche of applications in our hands, but it's a luxury. We're happy with that. We're not going to complain about that. But this is a challenge that we have to tackle. Fortunately, what we have is strong leadership and even stronger colleagues within the ECMA who are going to handle this. So this is the journey. Regarding the requirements, it's we have to, every issuer has to provide disclosure that would make an investor make an informed decision. We have several parts to that, so any issuer from now on, has to register with the ECMA before they can issue securities to the public. That registration process will require a complete disclosure about the business of the issuer, its risks, its potential rewards and everything, so that every investor will have the necessary information to make an informed decision. So at this today, what I can say to you all is that ECMA has been deliberate. We had received, there was a legacy issue, meaning there was issued securities before the coming into picture of ECMA and the regulatory framework. So what we said initially was the first job that we need to do is deal with this kind of issued securities. We have done that. We are in the process of doing that. And also we're receiving new applications or new registration applications for issuance of new securities. So today, what I can say to you all is we at ECMA have concluded one chapter. Of course, there is, as you have heard this morning, there is a lot of challenge that is going to happen in the future. There is a lot of things that's going to be expected of ECMA, but we can proudly say today that we have concluded one chapter of the capital market journey. That is bringing into the regulatory framework of existing shares and issuance of new shares. So that's where we are at this time. Thank you.
Thank you so much, Solomon. One of the things that actually stood out to me was the emphasis that the regulator gives to the protections of investors' interests through the disclosures made to the public. And I know Nigeria has a rich experience or an active equity market, to say. So what are the minimum safeguards or the minimum standards that the SEC Nigeria puts forward, specifically in relation to the offer documents when they're in the process of approval? So what are these minimum safeguards? And in relation to this, I also want you to give us your perspective on what minimum standards are expected and what issues slow down approval processes, and what are the major or indicative signs that help companies register or decrease the approval wait time.
Thank you, Samira. So Nigerians' perspective of regulation, basically, first and foremost, investor protection as it is in the capital market everywhere. Then secondly, ensuring that the market operates in a fair, transparent, efficient, and very clear market terms, and also to prevent systemic risk. So in so doing, our regulation centers around the rules in line with our ISA, rules on what is expected to be disclosed in the offer documents. And then in reviewing such applications on offers, we ensure that disclosures are completely in line with our rules. We do not joke with any limitation on disclosure requirements. So such disclosure requirements, as well as some documentation requirement that needs to be filed, will say in the offer document, the first and foremost submission we expect to see, plus document as well as disclosure in the offer document, is usually shareholders' resolution authorizing the issuance, either board resolution as well, with clear terms and conditions of the offer that is supposed to be issued. And then another key disclosure factor is the risk factor. The risk factor that will be disclosed must not be a generic risk factor. It must be specific to the issuer, as well as the sector of the issuer. Then another key thing, which I can hear every other regulator has mentioned, is financial disclosure. The information of the financial summary, and independent audit by a reporting accountant will be disclosed in the offer document. And auditors also confirm the going concern status of the issuer. So for issuance that has to do with bond issuance, I can say that some of the disclosure are peculiar to certain either equity or fixed income. So for a fixed income transaction, we expect it to be an investment grade rating, so the rating report must definitely be disclosed. And then in addition to that, we expect to see a corporate governance disclosure in the offer document, stating clearly the board composition, the management team. This gives investors a confidence as to who they are putting their monies in trust. Then another issue here is we ensure that the issuer gives a declaration of full disclosure, as in a sworn declaration that yes, every information provided in the offer document is true and fair information. And no concealment or no false or misleading information is disclosed in the offer document. Then you mentioned mistakes in offer submission. I would say that when you file an application, that the documentation is incomplete, we definitely cannot proceed with any process there. And then in most times, we just return the application because it's incomplete, and then key information and key documents are not provided, so there's no base for reviewing such transaction. Another very, very valid point we look at, as I mentioned, is financials. So if it's a public offer, we expect a very, very valid financial, which must be 9 months validity. So anything outside that, the offer cannot take place. We must have a valid account. So when you file, then you have some documents today, tomorrow you bring another document, and this inconsistency in your filing will reject the transaction in entirety. So you said what must be included in, like I've mentioned, every disclosure must be provided. There is no one disclosure that we could say, yeah, without this, an offer can be allowed to say it can be considered as an approved transaction. So every disclosure I've mentioned, the board resolutions, shareholders resolution authorizing the offer, the financials, issuers declaration, the ratings, and again, maybe for government, that's of nationals issuance, another key factor we take into consideration is the debt sustainability analysis, and then we ensure that there's an ISPO, which is an irrevocable standing payment order that is provided by the state. Then a trust deed is very key. Then with the new ISA, the proceeds from the offer for a subnational must be with the custodian, not with the state governments. That's the new provision in the ISA. So, and then for project-tied bonds, we expect the proceeds also to be safeguarded, and every return from the project must be, the proceeds from every return, as in revenue from the project, must also be ring-fenced. So basically, those are the key and very fundamental factors we consider before we approve any offer. Thank you.
Thank you so much, Ms. Adama. The regulators have told us the minimum standards and the frameworks that are in place, but I'm sure that it's the advisors that translate these frameworks into practice. And Mr. Peter, given your experience and work that you have done to guide companies go through this process, what would you say are the most underestimated things by these issuers when going public or raising capital from the public? And I also want you to raise some of your perspectives, to tell us some of your perspectives on the expectations, what expectations shock these companies after going public or post offers. Is it the scrutiny from the advisors or the analysts, or is it the compliance cost, or is it the expectation from the investors that shock companies?
Thank you so much. Once again, good afternoon, everyone. I think I should start on a note of commendation. I want to commend Ethiopia Capital Market Authority. This indeed is a step in the right direction. And I love the fact that you are, playing the key role. And truly, there cannot be any developmental or growth in any economy without the growth of the capital market. And this is the center of things. Having said that, United Capital, we are a key player in the market in Nigeria. We are investment banking and financial services group. Fortunately, we are listed. We got listed. So in terms of experience, we have taken several businesses to the market. We are equally in the market. So we got listed in 2013. So this gives us a very strong insight, having been operating for over 6 decades. So clearly when, businesses are moving from private to the, being listed, organizations do underestimate a lot of factors. One of the factors is the fact that, an organization that has been run as a private earlier, we want to see that business as usual. But I can tell you, as a listed company, it's not a business as usual. Immediately, you have been approved by SEC to go to public, you are under scrutiny. They will scrutinize everything that you are bringing to the public. The market will want to go to the depth of checking the credibility of the management. They want to look at your strategy. They want to look at your governance. They want to look at your financial health. They want to look at your transparency practices. But, these are things that we should prepare for, but in most cases, they are not really prepared for. So, because as a public company, one of the major things which has been highlighted here is strong disclosure. And, and the market could be seriously unforgiving if they discover inconsistency in your disclosure, which is very, very critical. So the market wants transparency and clear disclosure. Also, I think I will highlight the fact that operational expectations, immediately as a listed company, you're going to be having investor communication, shareholders engagement, regulatory engagement, and transparency and timely, posting of your information. We should not forget the fact that the capital market itself is driven by information. And that's where transparency and timeliness is very, very key. So as you go into the market as a listed company, you must have it at the back of your mind that it's quite very critical to have that. And when you get listed, you want to look at what are those measures that come. One, you should realize that you are moving to a highly regulated environment because compliance is key. Compliance is key. Like, for instance, in Nigeria now, when you get, listed, you have to abide with the SEC Code of Corporate, Nigeria Code of Corporate Governance, and we have a NGX rule book. As a listed company, you must ensure you fall in line with that. In addition, you must be able to show a very strong corporate governance. Like in Nigeria, it is expected that you have a considerable number of independent directors. And that, again, gives confidence to investors. In addition to that, you must have the committees, strong oversight from the committee, especially in the aspect of risk, audit, and governance, which, regularly you must, at least do that. A major thing you do by the time you are listed in the market, you will now start engagement with investors because they will review your performance. You are expected to publish your report every quarter, and every quarter, shareholders, investors will review. They will compare you with their peers, with your peers in the industry, especially when you are listed in a particular sector of the market. They will compare you with your peers, and the market could really punish. Punish you if you do not meet with your forecast, and that. I think technically it's quite very interesting, at least from our own point of view. Quite interesting, being in the market. It helps you to restructure yourself for proper governance, which is required, and compliance. Summarily, I want to say, transiting from a private company to a listed company is a journey of a change in culture. Now you have to take up the culture of accountability, transparency, market transparency, market discipline, governance, strong governance, and you should see the fact that as you come into the market, you will partner with various stakeholders, not in short term, but in long term, and see them as partners in progress. Thank you.
Thank you so much, Peter. And as you've rightly said, moving from an unregulated market to a regulated one is a change of culture. And I want to move to someone who has been working in the Ethiopian capital market, I think for the last 1.5 years, and who has been working closely in the market and has witnessed some of the changes that are unfolding in the market. Mr. Simon, given your experience working in the mature markets as well as the Ethiopian markets, what observations have you made so far? And I also want you to give us some lessons that the advisors as well as the issuers who are hoping to participate in the market could take.
Thank you very much for having me here today. For anyone who doesn't know me, I'm Simon Olsen, partner at Deloitte. I've been very lucky to have worked on over 200 IPOs in my career, including IPOs on 25 different global exchanges, ranging from the big international ones like London and New York, through to up-and-coming emerging ones such as in the Middle East, across the continent, and most exciting, as you just said, here in Ethiopia, where I've been working now for nearly 3.5 years, actually, as we've pulled together the system here. And I must say, I too am going to start with a commendation and say really well done to you at the ECMA and to all other ecosystem providers here for what you have achieved in Ethiopia. I think it's very easy sometimes for people to underestimate the sheer effort required to get to where you've got to have a functioning exchange, to have a functioning regulator, to have a functioning ecosystem. So a big well done on that. In terms of my observations, maybe I'll start with a few overall ones. So firstly, having worked across a lot of different exchanges, what I would say is what I've done here in Ethiopia feels very familiar. So there's a lot of familiarity to what we've seen elsewhere on the continent, what we see internationally in terms of the process, in terms of a lot of the documentation, in terms of the way things have been thought out. And I think that's probably not surprising given we've looked at lots of different global exchanges in coming up with what we have here. But nonetheless, I think it's important to recognise that. And that means that there is a lot of international and continental practice that we can look to when it comes to what we're doing here in Ethiopia. I would also, on a positive note, obviously what we have has been customised for the Ethiopia situation, but also I think in many ways some of the international practice has been improved, in particular where we look at some of the uses of technology and other opportunities to take things out of manual form. The other lesson I think that's going to be very relevant across all aspects for people coming to this market is it does remain a new market. And where does that manifest itself? Yeah, it mainly manifests itself in a lack of precedent, a lack of examples of how things have worked in an Ethiopian context. And also, and Solomon was referring to this earlier, we're doing some things for the first time. When we led the IPO of Ethio Telecom, there were a lot of things that the country had never done before, and we had to work through from scratch. As we're doing live engagements now, in particular the ones across the banking sector, again, there are things that we're seeing for the first time and are having to be worked through. So I'd say for people coming to the markets, just be aware you might have to expect the unexpected, and you may well have to deal with some tangles for the first time. Now, I think it's important in that to recognise the importance of everyone in the ecosystem working together to create solutions and create precedents that can then be used time and time again. We're very pleased to have worked extensively with the ECMA and others over the last few years to actually achieve a lot of solutions to things that were being done for the first time. When it comes to certain other things, let me maybe talk a bit about readiness and preparation. I could be sat anywhere in the world and I would say the same thing right now, and that is, once you've decided you want to do an IPO, assessing your readiness and doing preparation as a business is absolutely critical. An IPO is a complex transaction. There are a lot of work streams that need to be got through. There are a lot of complex interdependencies. So it's really important to assess your readiness and to get prepared. And in the Ethiopian context, that's no exception. Now, I'm sounding negative. I don't want to be. IPOs are very doable. We've seen them here in Ethiopia. There are tens of thousands across the world. But my practical hint would be recognise what I've just said. Recognise for organisations this is going to be a big project. So when we're advising companies, we sit down and start say, okay, this is going to be a big project. So like any other big project, you need to plan, you need to assess what you need to do, work out the what, the when, the who, and then you need to work out your resources to make sure you have enough capacity in your organisation to get through that project. I think when it comes to some of the documentation, my observations would be that the documentation for any organisation coming into an IPO is going to seem pretty lengthy and pretty extensive. You're going to have to abide by the requirements. This was just said recently. When it comes to public markets, you can't pick and choose which regulations you apply to. You have to abide by the requirements. You have to work within the rule sets. And I think in an Ethiopian context, the documentation isn't just a prospectus. There are other things that need to be filed with the registration statement. And we have to bear in mind the requirements for the ECMA review. And that will seem quite timely. So from practical lessons learned, for companies, the process to do an IPO or a listing will always take longer than you expect. You need to bear in mind that those documents are actually there for your legal protection. They're not so much selling documents. And I've seen companies get quite upset by people saying, well, I don't really like the risk factors. We talked about risk factors. I don't like the risk factors. They seem negative. Number one, they're in every single prospectus I've ever seen across the world. And number two, they're actually there for the protection of the business in the future, should there be an issue. I think one of the big lessons I've learned in an Ethiopian context is to watch for changes required to the Memoranda of Association, changes to existing business licenses, and maybe just look at the approvals that are needed to get through the transaction, in particular for those companies that already have quite widely held shares, where you might need, for example, a general meeting of some description to make certain approvals. So work early with your advisors as to, okay, what are the chain of events needed? What are the approvals needed? What changes need to be made and approved so that I can get my transaction done? And the last lesson I would draw out on documentation is stale dates, as was mentioned here. I won't talk lengthy at that because it'd be quite boring for the audience, but financial information expires after a certain amount of time. You need to be aware of that and make sure you file your prospectus within that. And the last thing I would say, corporate governance, the speakers I think have already said a lot on that, but in any company in any part of the world doing an IPO, there will be a big step up in corporate governance. And the needs for that are going to vary. So for some businesses, say like a regulated bank, the changes can be less. For other businesses, for example, sometimes founder-led tech businesses, those changes are more. But in all businesses, you're going to need change. And that applies to both processes, but it also applies to culture. And that was, I think, well talked about by the last gentleman. But I think my lessons learned, specifically in Ethiopia, are make sure you understand the requirements, establish a program to implement the right corporate governance, recognizing it's going to take a long time. And I'd actually say critically, recognize that there probably will be a change in culture and you will need quite a lot of capacity building to deal with that. Thank you.
Thank you so much, Simon. And we wrap up our panel discussion on this. Just to give you some takeaways, issuer readiness is one of the key issues in this case, and investor protection as well as transparency are non-negotiables, and post-offer compliance, and that's what strengthens the market as well. Thank you so much for joining us.